Hello, Mark. Welcome to Options Brute. Market shot. We've got the Traders Workshop. I think Christmas has come early today. We are doing the Christmas tree spread, right?
We're going to do a Christmas tree. We're going to look forward to December. It's sweltering hot out here in Chicago, but all we can think about is those pine blossoms coming in a couple months.
Perfect. All right. Well, let's get to it. What's the Christmas tree? Tell us about it.
Yeah, so let's talk about a Christmas tree. And I think, this is just another natural evolution in this whole synthetics and spread relationships that we've been talking about. So we've been talking about the synthetics that build call spreads, that build boxes. We've been talking about how to take those call spreads and put spreads and turn them into butterflies.
Right.
And we talk about how those butterflies can be equidistant or they can be broken wing. And the Christmas tree is sort of the next evolution in that sort of, modification of the equal or zero net position spread. So, where you're long an equal number of options as you are short options. And so defined risk, always really interesting for traders to manage.
Right.
So a Christmas tree, the way that's specifically set up, if you'll recall, the butterfly is the one, short two, long another. A Christmas tree takes a little spin on that. And instead of being short two and long one, it's long one, short three, and then long two.
Okay. So again, important note there, as you said, just want to emphasize the long one, long two equals three. I know this is obvious, but I just want to make sure. And the short three equals three. On the short side, they net to zero. Very important that we keep our units in line. When I say units, I mean extra calls or extra puts in a case of a spread. So, typically in the retail world, you're probably not seeing too many short unit kind of things, net short units. So that's why these butterflies are great, because you have zero units, your risk is defined, end of story, right?
Exactly. And, another way to think about this is, we think about a butterfly as being long a call spread and short a call spread. It would be a call butterfly. This is a Christmas tree would be long one call spread and short two of another call spread.
Sure. Exactly right. We'll show that on the screen when you share. So I think, I'm going to ask, I don't know if it's an obvious question, but I'm going to ask a question. So can we do Christmas trees? Can it be like crazy ratios, meaning 1/4/3? Is that still considered a Christmas tree?
It's a good question. I think my nature is 1/3/2. That's a Christmas tree.
Right.
But of course, with these spreads, so long as you're netting to zero, they're all, of course, going to be different risk profiles, long one call spread, short three call spreads, or long two, short five, all of these offer slightly different nuances to what that position looks like. But functionally, they're all going to follow that sort of, tented peak in the middle. And what you're playing with are sort of the break-even points and like the width of the profit zone as you adjust those ratios. So
all right.
I don't know if they all have names, but you could call them different flavors of Christmas trees, I guess.
Okay, we're going to call them different spruces and what have you. We're going to come up with our own name for these different ratios. I love it.
So this might be your traditional pine Christmas tree that we're talking about.
This is the pine, the one you cut down out of the forest and bring to your house. All right, I love it. So that's the 1/3/2. So can we have a look at this? Are you going to share a screen?
Yeah, let me pull up my screen.
Okay.
And just to talk briefly about some scenarios that might be interesting in this. A Christmas tree definitely has a directional element to it too.
Right. And Mark, you just said, sorry to interrupt, but you said that it's a combination of a single call spread, so the 1/1 spread, and then a higher call spread that you're short twice as many times, right? So I'm going to just go out on a limb. You're going to explain this and say that it seems like the more shorts is going to give us a little short delta and a little short bias. It sounds like, to some degree here.
Well, I completely see why you say that, but what also is a really important factor here is the distance between the legs.
Good point. Yep.
So while
that can vary, right?
That can totally vary. So if you set, for example, here your long call spread, one I might set up here would be buying the 125 here, selling the 140 three times again here.
Okay.
And then I'm going to buy back the 145.
Okay, good. This is a good one. I like this. And you got a pretty delta neutral too, which is good.
Yeah, very interesting actually. This is the delta neutral spread.
Because look at this spread. So the short call spread on top is only a $5 spread. The long call spread down below is $15. It's a 15-point one. So that's actually a good point you made, that depending on the width of the strikes can govern how this thing leans.
Exactly. And, something like this is an interesting thing. And, I'll explain why I picked SIBO here. Because one of the big pieces of the news yesterday was that the CME was making a bid on SIBO.
Oh.
And so CME allegedly, they both denied it, but CME is looking across the street and saying, hey, we could buy SIBO. We can charge more for market data. And so the scenario you might use this, I'm looking out to December. Of course, it's a Christmas tree. But it allows you to do well if stock moves up, but not moves up too much. This is good. So, right here, spot is trading right around, 128 or something like that.
Mm-hmm.
And we're going to see the big profit zone for this is, as with all butterflies, where your long is fully in the money and your short spreads are fully out of the money.
Mm-hmm.
So, that two-legged call spread that we're short, we're short two of the 140, 145, and we're long one of the 125, 140.
Right.
So right at 140 is going to be that max profit zone there.
Got it. So, and then our max loss is what we pay for this. It's a 445 debit, right? And there's that 445 max loss, and that's all the way to the downside. Why? Because we paid money for this. It's a debit spread, so we're going to lose that debit when it goes beneath our lower strike, right? We lose that full amount.
Below 125, our max loss is going to be that 445.
Right. And interestingly enough, to infinity on the upside, we make a little money. Can you explain that? I think I know the answer. I see 445 debit and I'm thinking $5 spread somehow. Because don't forget, we have a $15 spread down below and we only have a $5 spread up above twice as many times, right? So I'm thinking that spread can go to $5 max, and we paid $4.45 for it, and that's the 55 cents that's left when it goes to $5. Is that about right?
That's a perfect way of thinking about it.
Okay, so I think when you do these spreads, you can do that analysis, because most people say, "Oh, I paid a debit for it." Well, my up and down side, I can lose that 4.45. Not in this case. It's not true. You can only lose to one direction by expiration. You don't lose to the infinity side of this one. Is that right?
That's exactly right. And that's what sort of makes these, defined risk spreads pretty interesting. And, it all will come down to the pricing of specifically how you line them up. But, it does give you that directional bias where, even if it goes way past your price target, you still end up making a little bit of money here.
Right. Right. Yeah. I love it. I think I like this spread. I just decided that this is my new favorite.
Really? The Christmas
I think this is my new favorite. I think, if I have a bias, I think I'm going to use these more often, because me personally, I just like selling a little more premium than buying it. I know it feels like a debit, but it's a kind of a weird, crazy debit. It doesn't feel like I'm, I want time to go by, and I want this thing to kind of inch up, and that's going to be good for me.
Exactly. That's exactly what you want. And you want a vol crush to come here.
Yeah.
So, this spread might actually pay out early, to the extent that a takeover is interesting, right? And that's why I chose a takeover stock here, because if there's an all cash takeover, vol is going to go to zero here.
That's right.
So your spread is going to pay out. If they say we're paying 135 cash, closing at the end of September, assuming everything were to happen regulatorily, that this spread would, pay out at the end of September, because vol would go to zero and your short options would have no value.
Yep, that's a good point. That's very good. Yeah, this is a cool spread. I like it. I'm gonna mess around with the weirder ratios, like the blue spruce and the the Edward spruce, and see what I can come up with.
You might want to throw some balsam fir in there.
Balsam fir.
The other thing that I'll note about these that is can be a little tricky to manage is that you did like the short vol aspect of it, and that's great. We can see that max profit,
sure.
$807 per contract if we land right at that 140.
Mm-hmm.
But that 807 is going to come at the very last minute.
Yep.
Because you're sort of short this decay, or you're long the decay, you're benefiting from time passing.
Mm-hmm.
That's really going to happen at the very end. So December 17th, December 2nd, November 17th, this is all of that kind of value accrues is weighted towards the end,
Sure.
right up towards expiration. So
Yep.
it can get very tricky managing this at expiration, and you actually might end up with a little bit of delta because as you're closing in on that 140 come December, if that's happening, you've got a lot of gamma about
Right.
how your position is going to change
Yep.
going into expiration. So they can be a little tricky
Yep.
to manage.
Absolutely. Good. Okay. Awesome show there, Mark. I like it. Very cool. Let's get back to the screen. No, that's good. That's good stuff. I like that spread a lot. So let's say goodbye for today.
Like you said, there's so many different ways that you can play with these spreads, and it starts to get really interesting. Selecting the different strikes, selecting the different leg lengths.
Right.
There's a lot of ways to play with these defined risk spreads.
Yeah, no, I agree. So I think this is terrific. So we'll come up with something really cool for next time. And again, thank you for today. That was excellent. And we will see you next time.
We'll see you next one. Have a great weekend, Lex.
You too, Mark.